So we are heading into the last panel before we head into the lunch break. And Frederick spoke about how actually the current system looks like. And we're just adding on modules and it's fragmented. And guess what? In our next panel, this is exactly the topic, from fragmentation to flow, and the playbook to onboard the next era of institutions, because they are here, they want to be part of it, but how do we onboard them? So in this panel, we got Paolo from Berglinde, who will be moderating, and the floor is yours, and I'll allow you to introduce your panelists. Please put your hands together.
Good morning, everyone.
Can you take a picture at some point? Thank you so much.
Here we go. I mean, the previous panel, we had like 3 successful banks that have integrated digital assets. So let's try to not to be too pessimistic, but I think it's a fact that we are still facing a lot of challenges, a lot of limitation for institutions to adopt digital assets at a scale. So maybe let's start with a short introduction. You want to start?
Absolutely. Yeah. Thank you, Paolo. Hello, everyone. I know it's hard. Thank you for being with us. I know we're competing with lunch, so it's not easy. My name is Elodie, and I'm Chief Operating Officer at Kaiko. Kaiko is the leading data solution provider working on market data, analytics for risk management, and indices.
Thanks, Paolo, and thanks for being here. My name is Frank. I'm running sales for Talos in EMEA. For people who don't know us, we're the institutional grade technology provider, providing all kinds of technology services for people who interact on the digital asset ecosystem.
Thank you. My name is Katryna. I represent Wintermute. We're the global leading market maker and OTC desk, have been founded in 2017. And prior to crypto, I spent 15 years in traditional finance covering institutional clients.
And hi, I'm Jonathan Mathai from G20. I'm one of the co-founders and head of trading there. We're a cross-asset trading firm focused on derivatives. We trade in FX and commodities and also digital assets.
Thanks. Institutional normally talk about fragmentation as a kind of like barrier to enter and adopt digital assets, across exchanges, blockchain, technology, standard. Maybe let's start with you, Elodie. Like, how do we see that, and is it really true that fragmentation is somehow preventing institutional players to enter into this industry?
Yes. Maybe before we talk about fragmentation, let's just take a step back and understand why is fragmentation really so crucial and a barrier to entry of institutional players. I'm sure you all heard about, how blockchain can enable better, faster, cheaper capital markets to reach to the 16 trillion opportunity by 2030. The thing is, to get there, yes. However, fragmentation is standing on the way. Because we think of, as you said, today you have some barriers to entry. For example, if you're an institutional player and you have to deal with multiple blockchains, multiple exchanges, centralized, decentralized, you have different wallets, you have different interfaces. All of that brings actually the opposite of what the blockchain is promising, basically making more complexities, more intermediaries in some ways, and more risk, counterparty risk. And all of that is doing one thing, it's actually bringing liquidity down. And I think everyone in this room can understand that if you don't have liquidity, markets cannot grow. So I would say that today, fragmentation is definitely a barrier to institutional players entering the space. We're seeing, however, even if I mentioned that you have the fragmentation on the blockchains, on exchanges, on liquidity, also, collateral management, because if you have several places to trade, it means that you have several prices. If you have several prices, it means that it's hard to know what's the value of an asset. And all of this has implications on a lot of different stances. However, on a positive note, we do see some convergence, I would say. I'm sure you heard of some of the bridges with Wormhole, Layer 0, Chainlink, CCIP, for example. We're also seeing some custodians as well, enabling more mobility across assets, across chains. We talked about interoperability, new standards. So we do see some convergence. However, the fragmentation I just introduced the topic with is still very much present. And we need each of us in the room to work towards that in order to onboard more players and more liquidity at the end of the day.
Yeah, very good point. Maybe Frank, you spent a lot of year working with institutional players, banks, to integrate digital assets, cryptocurrency in their products. do you see any meaningful progress? Like, are we doing some progress? Like, things are getting better, or we are still adding complexity for them?
I do think we're still adding more complexity, in all honesty. In all honesty, it keeps us also at work, because that's the layer we want to bridge and make sure that, let's say, all the fragmentation can be seamlessly interacted on all the institutional players. But yes, we're far from convergence at the moment, in all honesty. I think things are progressing, but even take a look on all the different protocols out there, right? I mean, if it's on blockchain, or even, let's say, on fixed protocol, WebSockets, REST API, decentralized, on-prem, off-prem. I mean, there's so many elements there which, let's say, makes it difficult for participants, let's say, to interact seamless within the ecosystem. But yeah, we're building on it. And I think helping the industry to understand, let's say, what's needed to get to that phase, hopefully then institutional adoption will follow.
Yeah. I mean, if we look like at traditional finance, something that it has been already solved now since here is market data. I mean, traditional players, they rely on very unified with high integrity data market data. Maybe because this is exactly what you're doing on a daily basis. Yeah. How do you see, like, and why we cannot reach that point where everyone can work on the same standard regarding data?
Yes. Maybe I can start going back to today you have a fragmented market, and when you are any type of market participant, so regardless, like you're a trader from a buy side, or you're a bank, or you're a regulator, or you're a custodian, or a payment solution, anyone throughout the investment lifecycle need data. And today it's hard because you have everything that's happening off chain, and so that's the traditional API WebSockets. Then you have everything that's happening on chain, but you have different protocols, different programming language. So if you want to extract all this data, then you also need to basically apply to compare apple to apple. You need to retro-engineer some of the protocol to understand how they are built. So you have complexity at different levels due to that fragmentation. So that's one thing that we're seeing, at least, like all participants, to make investment decisions, to also look at monitoring and surveillance. If you look at custody, we talked about collateral management a bit earlier. Basically, if you want to do some lending, you need to have a price that everyone agrees upon. If you're a custodian, you have your asset under custody, guess what? You need a price for that. If you are a fund, if you want to show to your LPs that you made money, you also need a price for that. And guess what today? We don't have a standardization. There is not single Bitcoin price. When we talked about, Bitcoin, crossed another all-time high, 112,000. From which exchange? You have 130 different ones. And today, that's still a challenge that we see in the market and that we're solving for, to bring standardization. Today, we can provide prices for spot, derivatives, for ETF, ETPs, all across the chains to bring more seamless operations, I would say. But that's still, today, one of the key things, as everyone talked about stablecoin as like the killer app, I think that pricing for collateral management, when you talked about composability and really unlocking all the power that blockchain means, you need to have one price that everyone agrees upon. And that's one thing that, among other things we do, backtesting and all the other things that we can provide, pricing and have everyone on the same page is key to enable the growth of the ecosystem.
Yeah. Katryna, like from your perspective, Wintermute is a key player here. Like, how do you deal with inconsistent market data? Because I guess that heavily affect your business, and also how do you like mitigate that risk of dealing with different data sources?
We had to build everything from scratch, right? So when the company was born, literally at the kitchen table, then transferred to Weaveworks, everything had to be built as a proprietary infrastructure. So our market data, we're currently integrated with 65 plus venues across DeFi and CeFi. So everything was built, in a proprietary manner. The same, if you look at I agree with what Elodie is saying, that the market is fragmented, but actually we thrive on that, right? We welcome decentralization. We don't want any exchange or any player to become too big to fail, and we feel that it's very important to rely on ourselves. So we have our own API stack, we have our own market data, and we feel quite often when big institutions, and we cover ETF issues, custodians, banks, all of the biggest players, when they come and say, hey, I want to do this block size, what are you referencing your spread against? We're like, it's against our theoretical price, right? Because we believe that that's the most representative, and then we add the spread based on where the market market is. So from our side, I think we're almost, again, going back, we were just discussing before the panel, some of us come from a FX background, some of the banks were almost effectively running their own dark pools, right? They had so much data collection, so much trading interface, they could internalize it all, and hence they were able to provide the most competitive pricing. That's effectively the role that Wintermute is playing now. We trade, 20, 30 billion per day, probably single-digit billion on the OTC market. So again, for us, providing pricing from our pricing engine into, largest exchanges and getting 40-50% market share versus providing it to the largest OTC, retail brokers, banks, institutional players, it's the same pricing, right? And it's based on a very, very accurate source of market data, which is going back to your question.
Yeah, interesting. And Jonathan, the other day when we talk, you mentioned something interesting. You said that the way that you see the current market, it reminds you the early day of FX. Why is that, and what can we learn from these days and prevent the same mistakes?
Sure. So I think the really interesting thing about crypto is that we get to see the infrastructure and liquidity build up in a completely new asset class. And for those of us who come from a traditional finance background, it's useful to use the journey that we saw there as a template for what could happen in crypto as well. So as an example in FX, in the early days, maybe 20 years ago, showing my age a bit, but the trading floors in the large investment banks, who were the liquidity providers, were very big, lots of traders, everything was manual, it was very noisy, and that's very different to how it is now. Now there's a lot of volume, it's very liquid, it's quieter, everything trades electronically, and it's very efficient as well. In the old days, you could potentially manually arbitrage. These days, it's all handled via very sophisticated algorithms. So I think that same sort of transition is going to happen in crypto, with many of the key milestones also happening as well. I think we've gone through the equivalent of a GFC in 2022, with FTX going under and many other liquidity providers going under. And I think that taught us a lot about trust in the market, and how you really can't trust anyone. You've got to be careful about everything, which is the same lesson that was learned in TradFi. I think the other things that are going to change is that there are going to be more liquidity providers in the market. In TradFi, there are at least 30, potentially more, offering the same service in the market. But in crypto, there are very few. There's a handful of people that you can trust to show good liquidity and be there for you. I think the other thing is about derivatives. I think that's a big deal as well. A lot of the liquidity that comes in TradFi markets, for example, in FX, there's about 6 trillion of volume that trades every day. A lot of that comes from the supply of vol from many different wealth management banks and things like this, which help create order books, suppress volatility, and provide liquidity to the market. That same thing will happen in crypto as well. I think it's largely nascent in altcoin markets, but it's doing pretty well in Bitcoin and Ether right now. And I think we've seen a trend lower of volatility, which is what you'd expect to see from a maturing market. So I think these kind of things will be milestones and help improve liquidity in crypto as it develops.
Interesting.
And maybe can I just go back?
Yeah, please.
You said, Katryna, just on the pricing, because I feel that sometimes it's something that's a bit overlooked. Is today pricing is not. You have several methodology, in terms of how you calculate the price, and you need to have outlier management, and basically it's not just looking at all the trades. And I just want to anchor that because I feel that it's a hidden threat that we all face. If you don't have proper pricing, then the rest, waterfalls, I would say. And just one thing is, what we have seen, at least, we have compared several methodologies from mathematical standpoint, and we cannot just look at all the liquidity that's out there and aggregate it. You need to go into way more depth, and there is some outlier management, and especially in crypto, it's super volatile, and you have had several crash, right, with FTX and others. You cannot just take prices, aggregate them, and deliver it back. I think you need to go one step further, and that's why, in our opinion, you should definitely have a partner into how you do this. And it's just one thing that, you mentioned to it seems super easy when you said it, and it's something that I think, a bit overlooked sometime today. And as we see more maturity, at least, like we've seen more clients going into the market and asking for more specifics and really doing some, like testing and really looking at, okay, when there is a crash, like you have some of the pricing methodology that will actually have a very big price difference, even for Bitcoin. And so it's something that everyone, I mean, if you're part of that ecosystem in traditional finance, spends a lot of time and energy, and I think crypto should be the same, and something that we need to learn from traditional finance.
Yeah, I guess Katryna, you agree with that as well?
Yeah, absolutely. I do agree with that. And I almost feel like, sometimes when people come and say, what was the law of the day? We would not go and say, well, look at this exchange or that exchange, right? Like, again, for us, the exchanges, the way we see them, some of them have been obviously, very, very competitive in terms of, the offering. But it's a multitude of offering, right? So coming from an institutional background, I worked 5 years at Credit Suisse, which I used to be proud of. Here, it seems to be only managed in the kind of these negative connotations. Again, any institutional approach is, when they come to us initially, they say, hey guys, like we're looking to start. We were going to start with a one-stop solution, right? Because we kind of want to try it, right? Like, dip our toes in the water. But then later on, they realize they don't want to face an exchange that potentially has a custody, that has an OTC desk, that has a prime, that has all sorts of offerings, which would never happen in TradFi, right? You can't imagine a prime broker also running their own exchange, right? That's not just, it's a misnomer. So hence, with time, they realize, okay, we've tried it, we've tested it, our compliance is comfortable, we've got all the boxes ticked. Now we want to optimize. We need a professional, market data provider. We need a professional, API provider. We need a professional, liquidity provider. We need to also optimize for margins. And that's when it goes to the next institutional level, exactly. And that's where we're the key player, for sure. Yeah. So quite often that conversation starts very early on, where we kind of almost holding their hand and saying, okay, this is how things work in crypto, right? You have to figure out the inventory. You have to figure out how you're going to transfer from one exchange to another, right? So even if the market data is tell you, buy here, sell there, you can't very easily transfer that inventory unless you have automation of that inventory transfers, right? That's the biggest hurdle. Because again, there's no prime brokers, there's no kind of proper, cross-margining and netting. So all of that is being built in the background, with some of our partners, with some companies we invested in. But when it comes down to kind of making it an institutional kind of space, it is still a long way to go outside of, majors. Yeah, for sure.
It's actually funny, right? Because we took decades, let's say, to standardize the workflow in FX. And actually, we can learn from that, at least what we think. So everything is, let's say, over fix or even on binary. And what we do in a new digital asset class, we go back to WebSockets and REST APIs. So it's quite interesting to see that even think we can leapfrog, let's say, on what we've learned over the years. There's still some challenges to come to that point. But I agree to Katryna as well. I think the biggest hurdle as well, the credit element, right? I mean, we saw it in FX, if you make that let's say, in a comparison to crypto, I think as soon as we have, let's say, a prime broker or a proper credit intermediary, then we'll see proper institutional adoption, and then we'll have, let's say, more people coming into this arena.
Yeah, and I guess from Talos' perspective, like, you're really trying as a technology provider to kind of like mitigate all these challenges.
100%. I mean, yeah, that's our bread and butter, right? Yeah. So we try to work with all the participants, make sure that we are, let's say, that layer on top of everybody to make sure that you can seamlessly interact with all the participants. But even then, it's sometimes a challenge, right? In like I said, legacy systems, even in our digital assets ecosystem, talking about WebSockets, REST API, fragmentation, it's still a challenge to get it all under one same bucket. Yeah. But again,
I think just to add to that as well, like in the TradFi days in FX, we used to have this idea of wrong way risk, which was the fact that you're facing a counterparty that may not be there anymore. Yeah. Mm-hmm. And it's one of the challenges in crypto and also in FX to some extent is that you don't really know your position. You may think you have a hedged position on different venues, but really all those prices could be completely different. They may not be the same thing exactly, and you may not have one of those legs. So like you said, the credit intermediation is a very big deal. Once you can have a pretty much guaranteed equivalence, that's a massive deal for everyone.
Yeah. And Katryna, you said something interesting before. You said that I mean, nowadays you have like exchanges that are doing basically everything from OTC, custodians, and I mean this is a setup that would be unthinkable in traditional finance. The question is why we end up in this situation, and is this like vertical setup good or bad for institutional players that are entering the space?
Oh, it's a loaded question. I have to be careful. I mean, exchanges are our partners, right? So we need exchanges. Exchanges need us. We're one of the largest market maker for many of these exchanges. And we also support the RFQ business. So quite often they would have kind of like a retail converter type style, distribution, which is very akin to retail brokers, the trade CFDs and TradFi, right? I guess it's not good or bad, it's just it's the state of the market, right? So the way that the exchanges were built originally is they were welcoming every player, right? Me as a retail player, I even tried to onboard with different exchanges. Some of them didn't even ask my KYC, right? Like I could just go in with my Gmail account set up. With others, I was restricted due to UK location, but I could use my alternative passport and kind of, have some kind of checks what is on offering. And many of them are catering for the retail kind of demand. And I think that's kind of how originally many of them started, right? And then because the retail demand was so attractive from market makers' perspective, right? Of course, we want to, price the retail uncorrelated one-directional flow, right? So many of the market makers started plugging into those exchanges to provide the, where there's demand, there's going to be supply, right? And some of them, I guess, grew so kind of very gradually to become solid institutional players, right? Where they have good, solid, regulatory frameworks, they have compliance frameworks, they have proper, tier one venues in terms of where they incorporated. So similar to us, when someone comes and says, hey, Wintermute, we want to trade with you, how are you comparing to exchanges? We say, well, for many of these so-called exchanges, you're actually facing an offshore entity. You have no idea about their financials. They will never share it with you. It's a very, very kind of non-transparent process, right? With us, we're UK regulated, we're UK registered. We have 3 billion balance sheets. So from a counterparty risk perspective, it's much easier to face us than many of those so-called exchanges, right? It's kind of mainly, many of them are integrated brokerage houses effectively. But then again, there are some exchanges who are trying to do it right. And it will be interesting to see how the space developing, right? You have seen some exchanges now talking about getting banking licenses, right? So then it could be possible that they grow into a kind of the space where the exchange is used as a banking partner, where, you use it for all of your transfers. You have your pay ID, you have your unique ID, you use it for custody, you use it for all of your operations. You have a card that is issued by an exchange, right? So it will be interesting how the space evolves. I constantly have to challenge myself on my TradFi bias to say that if this is the things that are done in TradFi, it doesn't necessarily mean it has to be done that way in crypto. You have a lot of, Silicon Valley engineers coming and, and reimagining the space. So I think we just need to welcome whatever comes that way and just make sure we do it with integrity and ethically and be able to compete. So that's why we, for instance, only compete in one lane, execution only. We would not do custody. We are not managing anyone's money. We're not an asset manager. We're not a hedge fund. We're just purely competing on execution. That's our strength. And I think for proper institutional players, that's important from a risk diversification perspective.
Do you agree, Elodie, or?
I would say yes. I like how you say basically, let's say the best of crypto, and there is a lot of innovation being fostered by digital assets. Let's leverage that. And it's true that it makes it easier, right, if you have everything in one place. However, coming from traditional finance background, I do see like there are a lot of risk. And that's why I would say I've been maybe a bit more moderate than you, Katryna, on that sense. It is, I mean, you have like some, potential risk with front running or misuse of assets if you're both a custodian and a broker, I would say. I see the risk, and if you look at the history of finance, we have seen a lot of, hacks, let's call it this way. So we should also not forget about that. So while I do think that this can fuel more innovation and remove some of the friction, which, we have in traditional finance. However, we should also not forget that a lot of hacks and a lot of money has been lost, and at the end of the day, it's the usually small players that are impacted. I would say. So I would think that we should go towards more separation, just to keep everyone's in check.
It's also what institutions know enough, right, and familiar with. I mean, you have the brokers, you have the execution things, you have the credit, you have the settlement. So it's quite easy for them to understand, let's say, that from a market perspective and how that would interact, let's say, with our ecosystem. But I think that makes it much more easier to understand.
I think also with the exchange mix as well at the moment, you have a real spectrum of very high quality exchanges all the way to some lower quality exchanges. The higher quality exchanges, I think they're becoming more regulated and better structured, but that is causing them to slow down in terms of things like listings and new products on the exchange. And that may actually really lead to more fragmentation as the others who are going to market end up going to the smaller exchanges, which may not have as much structure and protection for users. So I think that's definitely a challenge that is happening at the moment.
Yeah, definitely a good point. I mean, today we heard a few times talking about tokenization of real-world assets. And I mean, I think that the hope was that was somehow like the bridge between traditional finance and digital assets. But we are still like lacking a secondary market and other relevant infrastructure. Maybe Frank, how do you see that? Like, is this like because we are lacking, regulatory clarity, technology to allow institutional player to actually trade and settle tokenized real-world assets?
Yeah, I think you pointed out right. I think the lack of a secondary market is key, right? I mean, tokenizing anything is very easy and possible today. Depends a bit where you are or what you want to do with it, but how can you make sure that you can interact on it? How you can trade on it? Where can I settle it? Who are the participants? Does it speak to traditional finance systems, back office systems? And again, even then, just think about, for example, ISIN codes. I mean, what we know from traditional finance, right? I mean, how can we make sure that when I tokenize my water bottle, that everybody knows that this is this water bottle and not the water bottle on my left-hand side? So I think there's a lot of work to be done. There are good initiatives happening, particularly here in Europe. But I think it takes a lot more time, I think, for that being settled and clear how that will work. But yes, tokenization is a buzzword, but the true adoption and things for institutional players to actually work on it, with the exception maybe from some money market funds who are being tokenized, stuff like that, I think it's very early days.
Yeah. Jonathan, do you see it in the same way?
Yeah, I think so. I think one of the things with this, which I think was already alluded to, is that there has to be demand from some part of the market from these institutional players. When there's demand, there's likely to be some spread crossing, and as a result, then liquidity providers will come in to show that market. At the moment, I think it's still very early days, like's been said, and it's there's not that push from the demand side for it as yet to cause that liquidity to come in from the liquidity providers.
Yeah. Katryna, Elodie, you want to add something on this topic?
Maybe one thing, or go ahead if you want.
I'll go, yeah. I mean, we welcome their kind of 24/7 market because we're already geared towards it, right? I think what we are saying, and that could be quite an interesting opportunity for crypto-native market makers, because quite often when we kind of even, we know friends, in HFT space and TradFi, for them 24/7 is a big leap from going from 24/5 where the market's closed. Obviously, on a personal level, life-work balance, that's not ideal because you have to be plugged in all the time. But we already built the infrastructure for that type of 24/7 coverage. So I think, as mentioned, once there is demand and we will see there's volume, it's a volume game. It's going to be volumes, and we see more equities being traded on Saturdays and Sundays. Why not? We'll be there to support it if there is demand, for sure. It just gives you extra opportunity to potentially monetize that far. So yeah, I think we welcome all of their innovation, provided there's real demand, as opposed to supply being created without the demand following. But I guess it's just kind of, there's always kind of a little bit of that time lag, right? Where, we see a lot of their exchanges already, announcing, tokenizing equities, and they're probably seeing it as the next big leap because it allows them to add extra 2 days out of 5 days that is no one usually catering for. Yeah.
Yeah. I would just add one thing on that is, I agree with what you said. Basically, it's like we need to, I think tokenization, and we'll see more demand once we have use cases that actually solve for a true challenge. Sometimes I've seen like a lot of POCs, which are more, it's interesting to tokenize X, Y, and Z, but if there is no real challenge that this is solving, I don't think we'll see traction. So regardless of, definitely there's still some fragmentation. Like we need to solve for infrastructure play. There's still a lot of things to do on that, on like price discovery, on the on-ramp, off-ramp. How do you go, move assets across chains? There's still all of that to solve, but I think the most important is to go back to what is the actual challenge that's being solved. And we've seen it, like some of the tokenized product, money market funds, tokenized deposits recently in Hong Kong. I think we'll see some tractions where there's an actual challenge to be solved regarding the geopolitical and macro we're in today.
Yeah, and do you believe like this is like more like a geographical limitation? I mean, Switzerland I mean, we have seen like several banks starting to adopt digital assets, while like European Union is lagging behind. Is this due to like unclear regulation, or just like different requirement from the local players? I don't know, Frank, maybe you're working with like.
I think you see some POCs happening right now in different jurisdictions, and where, let's say, local regulators are trying to find out what's the best way forward. But I think if you're really talking about tokenization, you cannot do it on a local scale. It should be more on an international scale to make it similar for the institutional adoption. They're used to trade on a global scale. So I think there will be some limitations there, but we have to start somewhere. So let's hope that this will play out in some nice proof of concepts where people are really get familiar with it, and from there we can build on a bigger ecosystem. That's at least my point of view.
Yeah. Maybe one last question. If you have to identify like one big unlock that would enable the next wave of institutional adoption, what that would be? And maybe is this unlock something that you and your company is working on? Who want to start?
Happy to start. I think institutional players would like to see that crypto will come to them. What I mean by that, they want to, let's say, have the seamless integration, understanding, let's say, that they can talk to the internal systems to access, let's say, our infrastructure. So I truly believe that for institutional adoption, besides credit, which we already touched on, I think it's key that they are familiar with seamless integration, and then from there have, let's say, the ability to interact.
Jonathan? I think one of the other points is capital efficiency. In TradFi, it's very common to have prime brokers, which give you a large leverage on a smaller amount of capital. That's quite difficult in crypto because of the fragmentation. So I think once we have more products available on, let's say, the CME or on other venues like that, there'll be a lot more adoption.
Elodie?
I would say trust. I mean, what everyone wants today, and that's what we're all, I think, working towards, is you want to know that your assets are safe. You want to know that your trading is transparent, and you want to have clear rules. And I think we're, all working towards the three angles, and everything we talked about kind of, fulfill or work toward that. But I think if we manage to get trust, we'll see more liquidity in the market.
I'll go last. I think what we are saying our biggest focus on is structured products and kind of more exotic type of derivatives. We definitely see that institutions are used to trade and speak in those terms. So for sure, I think that's the space that needs to evolve, as well as the inter-dealer market to be able to hedge and do size meaningfully. So yeah, we're welcome to that.
Perfect. All right, we are running out of time and everyone is waiting for us for lunch. So thanks a lot for being here, and I guess you can find all the panelists later today going around. Thanks, everyone.
Thank you both.